A very special guest with me today, a man needs no introduction. Ridham Desai of Morgan Stanley joins us right now on the show. Ridham, great to have you. Thanks so much for joining in. Let's just start off with what we have left behind in the last 30 days, and that's a very news-heavy month, so to say, with the UP elections out of the way. 2-3 events which were key, which have been left behind, and now the market looks forward to earnings and possibly even the RBI policy. How do you map the course of the markets over the next, say, 1 quarter?
I think we should not disregard the events of the last month. A couple of very important things happened. I think the UP state elections was an important continuation of a trend that has been developing in India for the past 5 years. The electorate in India has certainly turned for a change, and it has been successively delivering strong mandates to either performing incumbent governments or new governments if the incumbent was not performing. And this is with the view that it is focused on development. And to me, if you turn around UP, it could have a big impact on India's growth rate, because I would argue that UP has been a drag on India's growth rate, just the way Bihar used to be. And we've seen the turnaround in Bihar over the past 5 years, and I think a turnaround in UP is fairly possible. It being the largest state in India and being a drag on India's growth rate, I think the potential is enormous. So to me, I don't think it was an event that we should just ignore. I think it was an important medium-term development for equities. Then the budget came, which obviously I think was probably less than what the market expected in terms of the noise it created. But I think the finance minister made a fair attempt at fiscal consolidation. Today, I think the market is skeptical. It's reflected in bond yields, it's reflected in equity valuations. So from an equity investor standpoint, it's a good thing, because you don't want to buy a market that is optimistic. You want to buy a market that is pessimistic. And if the market is wrong, then you make outsized returns. So I think we are in that situation. So to me, I think the March events were quite crucial. Coming to April and May, yeah, I think I agree with you. Corporate fundamentals, clearly something to watch out for. I'm focused on margins. I think we've gone through 5 or 6 quarters of falling margins. Corporate India has just not had the pricing power in an environment where costs have been rising relentlessly. So margins have got crushed. Top line growth, mind you, has been very strong, and it defies the prognosis that Indian economy has not been doing well, because if I look at a sample of 3,500 companies that we track, they've grown their top line by between 20 and 25% for each of the last 4 quarters. Okay, and that doesn't really signify a 6% economy. So there's something amiss there, and I'm not able to square the circle, but it seems like the underlying fundamentals of the economy are not that bad as the headline numbers suggest. However, corporate profits have taken a big hit because margins have fallen. So to me, I think in the next 2 or 3 quarters, revenue growth slows down, probably into the teens, and I expect margins to start improving, because I think inflation pressures are subsiding, and that itself will cause margins to rise, and therefore corporate profits will improve. And this quarter may prove to be a critical turning point in that regard. And yes, the RBI. I think the fiscal deficit number, I think, should have given the RBI comfort, notwithstanding the market's skepticism. So I think it does create room for them to make their first move on rates. So I wouldn't be surprised if they make their first rate cut. And maybe a CRR cut may also happen. So I wouldn't rule that out either, in order to manage the liquidity situation better.
What happens to fund flows to India, if indeed oil stays at these levels? Because there are positive arguments for oil coming down because of how global demand isn't that strong. And of course, the geopolitical tensions working exactly the other way. So oil stays at these levels, the elevated levels, and the currency being at the levels that it is, by virtue of India being such a large net importer. Does it spoil the macro picture or damage the macro picture so much as to affect fund flows, or you don't think that's a concern?
No, indeed, that's the case right now. I would argue that the macro picture is already fairly damaged.
That hasn't shown in fund flows, so which is what I was asking.
Yeah, but because that's in the price, right? We are talking about fund flows into equity markets, right?
Sure.
So they will respond to what's in the price. So the market is already pricing in a fairly poor macro picture. The market is pricing in 9% bond yields. The market is pricing in significant deceleration in earnings growth. Actually, we did some calculations. The market on a 1-year forward basis is telling us that earnings will fall by 7%. So it's quite pessimistic about the outlook. So it's in the price, right? So if it's in the price, then I want to take the risk that the market may be wrong about what's going to happen, and there is upside risk. So, the way I actually, when we talk to our clients, we're talking about the upside risk more than the downside risk, because I think a lot of the downside risk has played out in the last few months. Now, that doesn't mean that India's macro has turned around, that we have suddenly fixed everything. We haven't. But the risk is that if something of this gets fixed, then equity prices will give you outsized returns, because equities are right now pricing in a fairly dire outcome.
You are bullish on the markets from the current levels, assuming that the negatives don't turn out to be worse. I mean, bond yields don't go up majorly above the 8.75, 8.8 mark, and crude and currency doing what they are doing right now. Are you more bullish than bearish?
I would say that at the current levels of Nifty, which is around 5,200, with a 12 to 18 month view, I think equities probably will be the best performing asset class in this country. Now, if you look at 2011, it was the worst performing asset class. It actually delivered negative returns, as we know. But in fact, even over the last 5 years, equities have been a very poor performing asset class. And over the last 5 years, it has underperformed inflation. So you've not even been paid the deterioration in the value of the rupee because of inflation by equities. So equities has been a terrible asset class. I mean, contrast that to gold or even fixed deposits. Actually, they have been far better asset classes. Now, this is abnormal. Sure. And it will normalize over the course of the next several months. And I think at this starting point, it definitely makes equities probably the most attractive asset class in India.